This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Every day I'm reminded how news flow, whether economic data, earnings reports, or policy changes, matter a lot less to the markets on an absolute basis and much more compared to what was expected. Even then, the reactions you might have logically anticipated may have already been priced in well ahead of time. The biggest moves, either up or down, tend to come when investors are fearing the worst or expecting the best. So up next, let's think about this dynamic in the context of the recent backdrop. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Happy to be with you as always. Continues to be a very newsworthy period. Everything from the Fed to geopolitics to corporate earnings. Of course, we have first quarter earnings reporting season, so a lot to think about. But before I get into it, just to give me a quick minute diversion here. I read a interesting piece from the guys up at Ritzold Asset Management in New York. They always do a great job. And they cited a Michigan poll, actually. I don't know how extensive the poll was. But basically, people were asked to describe their opinions on the economy as well as their opinions on their own personal financial situation. Thought it was very interesting. Just 35% of people polled described the economy as excellent or good. 65% good or bad. But when asked to describe their own personal financial situation, a majority of people, almost 61%, said their circumstances were excellent or good, only 39% bad or poor. So the prevailing sentiment is, I'm doing just fine, but the economy stinks. Well, how is that possible? Particularly in an industrial state like Michigan. How is that possible? How do you reconcile that? And there was a similar poll I read from Gallup that showed that people in America are 5 times more satisfied with their own life than they are with the direction of the country as a whole. So why do I bring this up? Well, I think a lot of it has to do with politics. The more polarized we are as a nation, the more likely it is that Republicans think the economy stinks when Biden's in office and Democrats think the economy stinks when Trump is in office. So that's certainly part of it. But the other part of it is it's the news flow that's making us miserable. The world's always been a mess, right? We've always had wars and, God knows what, right? There's always something going wrong in the world. It's just that in the old days, we didn't hear about it as much unless we were listening to Walter Cronkite, right? These days, there is so much news flow, so much information. We are bombarded with bad news. There was a recent study. Unfortunately, I can't remember the name, but again, the guys at Ritzold mentioned it. They looked at 370 million stories on the internet. Lo and behold, the more negative the headline, the more people were likely to click on the story. So I'm not going to belabor this point. I would just say that it's very important that, and I've said this a million times over the years, and I'm going to say it even more as we get closer to November and the elections. Check your political leanings, your biases, what the headlines are saying, particularly if you read a certain type of news media, a liberal media or conservative media or, who knows. But the bottom line is the more you let those influences affect you, the more likely you are, in my opinion, to be poorly positioned from an investment standpoint. Okay? How much you have in stocks, how much you have in bonds, how much you have in real estate, how much you have in cash. Keep that in mind. Be very aware of the biases of not only your own biases, but the biases of what you're reading. Okay, enough on that. It was a lousy April across the board. S&P 500 down about 4% for the month. And maybe even more importantly for me, the bond market was down about 2.5%. So if you were a diversified investor, like most people, like you're supposed to be, you had a tough April, no question about it. And in fact, if you look at it in sort of technical trading parlance, the S&P closed below its 50-day moving average, which is a pretty reliable barometer of short-term momentum, for the first time since November. It ended the 10th longest uptrend in the S&P since 1950, 162-day uptrend, according to FactSet. But again, let's keep this in context, right? remember, coming into April, I think the S&P 500 was up ballpark roughly 30% since last September, October. And if you go back to the trough in October of 22, the quote-unquote bear market bottom, markets gained over 50% coming into April. So really, this is not a major pullback in the grand scheme of things. This is just a dent in what has been a pretty extensive upside trend, right? In fact, the move from October through late March of this year, last October, so whatever that is, 5 months, that's only the 7th time, according to FactSet, that the benchmark has gained more than 25% over a 5-year period since World War II. Only happened 7 times. And remember, and I continue to say this is par for the course, right? This is not unusual. If you go back a century, 5% corrections are perfectly normal. They occur roughly 3 to 4 times a year on average, going back 100 years. So let's not get too caught up in this. Obviously, we're always on guard for a more severe sell-off, right? I mean, but in the meantime, there's nothing I've seen in the last few weeks that's really concerned me. And there's also that I don't know if it's cliche is the right word, but you've heard that saying, right? Sell in May and go away. That historically we're entering one of the weakest seasonal periods for stocks. I mean, on the face of it, it's kind of stupid in the first place, right? I mean, who's going to dump their entire stock portfolio in May and then try to reposition in September? And pay a bunch of capital gains taxes. I mean, I don't know if anybody actually does that. But let's say that you did do that. Has that, in fact, been a good idea? Well, I think some of the numbers suggest that maybe it has been a good idea. If you look at, according to the Carson Group, they had an interesting piece on this. They looked at various S&P 500 6-month returns, and I think they went back, I believe it was to 1950. Okay, so 74 years. And they found that this period, May through October, seasonally does generate some of the worst returns on average, with an average gain of only 1.7%. And by the way, it's not a loss on average. It's a gain. It's just a smaller gain than what you traditionally see, or at least historically see, in other 6-month periods. But what's more interesting is, according to the same Carson Group analysis, in the last decade, it appears that markets have actually bucked this 6-month trend. It's actually been higher 8 out of 10 times in the last decade, producing an average return of almost 4%, which is actually pretty close to what you've gotten from some other 6-month periods. So when you read that headline, going back to what I was saying a few minutes ago, saying sell in May and go away, understand the actual history and the actual statistics behind it. And that is kind of lazy reporting, if I'm being honest. So I don't see a real seasonal reason to get significantly more cautious on the market at this point. The other thing I would just mention is, we've been talking in the last few months that because stocks went up almost unchecked, since late October of last year, that maybe we were all getting a little too fat and happy. If you started to look at the sentiment readings, it suggested that bullish sentiment was at some of the highest levels we've seen in a long, long time. Well, guess what? That's all reversed. I was reading some data just in the last couple days. If you look at AAII, the American Association of Individual Investors, bullish sentiment has reached its lowest levels of the year, down to less than 35%. Bearishness is higher than any point this year. Okay? So that doesn't mean that the market can't go lower, of course, but it does mean that a lot of the optimistic, bullish, in some cases euphoric sentiment has already been flushed out of the market, and the S&P was only down 4% in April. So again, it doesn't mean that we can't go lower, but it does mean to me that there isn't a ton of complacency in the market at this point, which probably tells me if we do get some more challenging economic news, inflation news, data that the market finds, bearish or might lead the Fed to be incrementally hawkish, more hawkish than where they are today, I don't know that the market is really set up to fail, like maybe it was a month ago when everything was kind of dandy. So speaking of the Fed, the big story, of course, has been the abrupt change, and I say abrupt because it's happened in less than 3 months, abrupt change in kind of what was expected versus where we are today. I said at the very top that absolute news matters a lot less than sort of what we get versus expectations. Well, flash back to January. The consensus in the first half of January, not only from Wall Street participants, but from the Fed itself, was that we were going to have as many as 6 or 7 Fed rate cuts this year. That was only 3 months ago. Here we are today. At most, I think the market is pricing in maybe 1 cut. And even then, it would be almost a ceremonial cut. Because not one cut at 25 basis points isn't going to do a whole lot, and that's priced to happen, I think, in September. Doesn't mean that that's going to be right. We don't know. We don't know what the economic data is going to bring over the next few months, but that's what the futures are saying today. So 6 or 7 cuts down to 1 cut in less than 3 months. But I would make the point, I don't think this is actually a bearish thing. The folks at Strategas came out, I think it was Thursday, and said a long pause, in other words, a pause between the last hike and the first cut, historically has been actually bullish for stocks. We're now at about 282, 283 days since the last hike. That is so far, that's actually the longest pause ever, at least going back to I shouldn't say ever, going back to about 1970. Well, historically, when we've had lengthy pauses like this, according to Strategas, on average, the S&P has appreciated during that time. In other words, I don't think the market really would want to see significantly lower rates at this point, because it probably suggests that something's wrong with the economy, that maybe we are going to get a lagged recession. So keep that in mind. The fact that the Fed isn't doing anything, the fact that the Fed is higher for longer, that's been a popular expression. The fact that the Fed's waiting to see what the data brings is not necessarily a bad thing for stocks. Keep that in mind. And by the way, if we do get higher rates, well, we have higher rates, but let's say we get incrementally higher rates or they stay higher for longer than people expect, is that necessarily bad for stocks? Well, going back to Ritzold Asset Management, they had some good data on that this week. I mean, just kind of intellectually, academically thinking, or maybe just logically thinking, higher interest rates devalue the present value of future cash flows, right? So all else being equal, you would think that higher interest rates would be bad for stocks. But in reality, the historical track record says something else. In fact, Ritzold Asset Management found that from 1950 through the pre-pandemic era, the average annualized return when the 10-year Treasury yield jumped 1% or more was 11%. Well, that's basically actually a little bit better than the long-term average performance for the S&P 500, annualized performance. So a jump in rates, there is no historical evidence that has negatively impacted stocks in any sort of consistent way. But and then they looked further, not just to jump in rates. They said, well, how does the actual level of rates impact future stock returns? I mean, surely when rates are higher, that should lead to lower returns, right? Well, data doesn't say that either. What they found is the lowest returns have come when the 10-year Treasury is in the 3 to 4% range and the 7 to 8% range. Those have been the lowest, and neither is the case today. Right now, the 10-year Treasury is around 4.6, okay? They found that the best returns come when rates are sub 2%, which makes sense because that's only happened a couple times, and that was exiting major troughs in the market. So it would be logical to think that that's where you'd get the best returns. But when rates are in the 4 to 6% range, like they are today, the returns have been pretty good. Consistently positive. Yes, there have been some slightly good years. Yes, there have been some slightly bad years, but on average, pretty decent. And I think the reason why this is the case is when rates are somewhat elevated, like I said, in the 4 to 6% range, you got to look at why is that the case? Well, in the 70s, you had obviously double-digit inflation and things like that. So, but in today's context, Higher rates are coming with a resilient economy, resilient consumer spending, unemployment under 4%. And what does that mean? Not only do you have good demand, but it also means with inflation over 3% that companies have pricing power. They're not having to cut prices to stimulate demand because the demand's already there. So, unlike a deflationary spiral where prices are coming down, companies are able to keep up their margins, keep up their earnings. So the combination of a decent economy and pricing power, good for earnings, and that's the current environment. So going back to what I said at the top, when you're reading headlines about, higher rates are going to be bad for stocks, historically there is no evidence for that. No evidence for that whatsoever. Speaking of earnings, of course, we're getting the first quarter earnings. Right now, we're about 60%, maybe a little bit more, maybe 65% of the way through reporting season. I think the early returns are pretty good. On average, we're at about 5.6% growth for the S&P 500 as a whole, year-over-year earnings growth. That's actually slightly better than what was expected going into earnings reporting season. And I actually read something from Strategas that Bristol-Myers, and I don't have any research opinion on Bristol-Myers, but just making the point that they took a $12 billion charge. If you actually add that charge back to the S&P 500, earnings growth was almost 8% year-over-year basis. It had that big of an influence, believe it or not. And if you look at the forward-looking numbers, consensus estimates are still projecting about 11% growth this year, 14% year-over-year bottom line earnings growth in 2025. And earnings estimates have actually been going up, as have revenue estimates. So again, these are just estimates. Anything can happen. But bottom line is it's very difficult for the stock market to do poorly when earnings estimates are drifting higher. Okay? I mean, that's the bottom line. I would also just one side note, we've talked about this before, that tech's outperformance over the last really couple decades, going back to the coming out of the dot-com bubble, tech's outperformance has been highly correlated with earnings. I mean, if you look at a long-term chart of tech earnings and performance, it's pretty close looking chart. But what's happening going forward is we're starting to see tech earnings, or at least earnings forecasts, moderate for the second half of this year and early 25. And earnings expectations for the rest of the market start to drift up. That bodes well, in my opinion, and that explains what we've seen the last few months, which a gradual broadening of the market. Remember, for the first 11 months of last year, it was just a handful of large, mega cap tech stocks that were leading the charge. The rest of the market was actually largely negative through early November. Last few months, we've seen that broadening. We've seen financials do better, industrials do better. Parts of healthcare do better. Even utilities do better. Energy do better. That, I think, will be mirrored by better relative earnings over the next half of this year. So a broad market, or at least an increasing breadth in the market, in my opinion, is a healthier market. So those are good things. The other thing I was just going to say briefly with respect to earnings is valuations are not cheap. I mean, let's just be blunt about it, right? And you can look at any metric that you want to look at. Price to book, price to sales, enterprise value relative to sales, price relative to free cash flow. I mean, you name it. All of them are in probably the 90th percentile or higher relative to the last 50 years, according to FactSet. So earnings have to be good. Is basically what I'm saying. And this is why I said what I said at the very top, that expectations are everything. And we're seeing it at the company level, the company-specific level. Because when the bar is too high, which could be the case with the market at over 20 times earnings, makes it very difficult to beat expectations, right? I'll give you a couple examples. And I have no research opinion on Tesla or Meta, formerly known as Facebook. They're not stocks that we widely own in the portfolio. So I'm not offering any opinion one way or another. But I just wanted to make the point about these two companies. If you look at what their earnings reports have said and the post-earnings release reaction, This is according to FactSet. So Tesla reported a 9% drop in revenues, which was their biggest year-over-year decline since 2012, a 55% drop in net income, and gross margins of a little over 17%. They were like 29% margins 2 years ago. So on paper, terrible quarter. Well, guess what? The stock went up 13% the next day. Why? Because the stock was way down for the year coming into the print. Expectations were very low, and they were able to beat a lowered bar. Look at it on the other side. Meta entered earnings up something like 130%. Stock price is up over 130% over the last 12 months. Sky-high expectations. They reported a 27% increase in revenues, which is their highest year-over-year growth rate since 2021, 117% increase in net income, operating margins of 38%, up from 25% a year ago. This is according to FactSet. By all accounts, that's a blowout quarter. Well, guess what? Stock was down 15% in the post-market reaction. So I'm not going to – I think you get the point, right, that it's not news in the absolute sense that drives stock prices. It is news relative to expectations, and I think that's why a lot of average investors don't do well on historically, or at least on a consistent basis. And by the way, our listeners are not average investors. Our listeners are wise investors. But the average investor, I think, just looks at the news and says, oh, they had a good quarter, or that company had a bad quarter, and makes their sort of investment selection based on that absolute news. That's not the way that investing works. You have to know what the market was anticipating, what the company's been guiding, what their historical valuations are, what their valuations are relative to their peers, what could be the catalyst for multiple expansion, what could be the catalyst for multiple contraction. And even if you understand all that, you still may not get it right, because there's so many other variables affecting stock prices. But at least you have a chance to quote-unquote win on a more consistent basis if you do that analysis. So just keep that in mind. Just want to get to a couple other things really quickly. A couple things on the macroeconomic front. Don't want to spend a lot of time on macroeconomics. But there are a few, and I'm not trying to look at the economy through rose-colored glasses. I'm fully cognizant of the fact that things could go wrong with the Fed still hawkish, and with rates as elevated as they have been for as long as they have been now, well over 2 years at this point. But on the face of it, I think there's some things that are a little more positive than the headlines would suggest. One of them was the fourth quarter GDP print, which showed a pretty big slowdown down to 1.6% growth year over year. But if you look at it a little bit closer, and this is according to the BEA, Bureau of Economic, I forget what the A stands for, but you get what I'm saying. Net exports subtracted almost a full percentage point from GDP. When net exports are negative, it means that U.S. import growth is outpacing export growth. That could easily just be a referendum that the U.S. economy is just a lot stronger than the rest of the world. So it's actually very well could be a positive referendum on U.S. consumer health. The other components of GDP were actually really good. Residential investment grew at almost a 14% rate. Business investment, almost 3%. Personal consumption, 2.5%. So look at the details of some of these headlines before you buy into some headlines suggesting that we saw a major slowdown in the fourth quarter. The other thing that I think is a little misleading are some of the data suggesting the U.S. consumer is getting him or herself in trouble. And they speak to the declining personal savings rate and the record high level of total credit card debt. But again, if you look at it further, the personal savings rate in February, according to the U.S. Bureau of Economic Analysis, that's the A I was looking for, analysis, the personal savings rate was 3.6% in February. That was below the 5 to 8.5% range before the pandemic. But just because the rate at which you save is down doesn't mean the savings you have accumulated is down. Just means the rate of change is lower. And why is that? Well, the market's only a few percent off its all-time high. Housing prices are at an all-time highs. When people feel that they have money, they're less inclined to save. So yeah, personal savings rates tend to go up when things are lousy because people are pulling in the reins, right? People are more, and that's certainly what we saw during COVID, right? Personal savings rate went through the roof because people were scared. People pulled in the reins, didn't spend any money. That's an extreme example, but that's what happened. So a shrinking savings rate is not necessarily a sign of trouble. And the amounts that are in checking and savings and money markets are at record levels, over $6 trillion. Same thing with credit card balances. There's a lot of talk about how credit card balances have gone up. But if you look there, credit card balances as a percentage of disposable income, they're back below pre-pandemic levels. And and household debt service payments as a percentage of disposable income are also below pre-pandemic levels. This is according to the Board of Governors of the Federal Reserve System data. So we'll be watching. We'll be watching for any incremental deterioration, but you have to look at these data points in context before you draw a conclusion. Last thing I would say is energy. There's been a lot of talk about higher oil prices and how that's going to impact the economy. Have to remember a couple things. Our consumer health, and I'm part of that, right, is likely less dependent on higher oil prices or lower oil prices than it used to be. For one, we've become more energy efficient. I mean, if you've been driving a car for a long time, I can't remember where I saw this data. I think it was EIA. But the average car now gets almost 27 miles a gallon. 1975, at the peak of the oil lines, gas lines around the corner, the average car was only getting 13 miles a gallon. Half as efficient. Half. And the other thing I would just say is spending on energy, goods, and services as a percentage of personal consumption. Very key metric. 1980, it was almost 10%. We spent 10% of our money on gas and fuel and utilities. Today, it's at 4%. So it's not that it doesn't matter. If gas prices spike to $4, $4.50, $5 a gallon, I'm not saying we're not going to feel it, but we're much less sensitive to that than we were really at any point in U.S. history. So just wanted to clear that up. Well, I don't know if I'm clearing it up, but I just wanted to make those points because we're starting to see those headlines, right? And it goes back to what I was saying at the top. The headlines are rarely positive. They're going to be alarmist. They're trying to scare you. They're trying to get you to read. They're trying to get you to click on the link, right? But it's very important as a wise investor that you know the details behind the headlines and don't make rash decisions in your portfolio. Up next, stick with me. I want to transition from the general to the specific, update you on what we've heard from some of our top holdings during this earnings reporting season. Back in a sec.
Decelerating inflation, higher interest rates, volatile stock markets, new tax rules. Don't you think your financial plan could use a refresh? Tune in every week to hear Simon Hamilton and Chase Hinderstein discuss the latest financial trends and what investors need to know. To learn more about some of the most important planning topics, considering how to become a better informed wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back. As reported, we're about 65, well, I guess roughly 2/3 of the way through first quarter earnings reporting season. So far, in general, at the index level, things have been pretty good. Earnings up roughly 6% year over year. That's better than what was expected if you look at consensus analyst estimates coming into reporting season. So obviously there are individual names that have done better than others. And as I made the point with Tesla and Meta earlier in the show, expectations mattered a lot. There were a lot of pretty good prints that were not rewarded with a higher share price because the stock had already maybe rallied coming into the print. And then we saw the reverse. We saw names that maybe haven't done as well year to date or in the last year, where the bar was very low, came out with earnings that maybe weren't all that exciting, but they were better than feared, and the stock price was rewarded. So got to know that piece of it. But just a few reports that kind of stood out to me. One was the report from Amazon. I think you all know Amazon, AMZN. And by the way, as you know, the names I'm going to discuss are all names that we own in many of our client portfolios. And if you're a client, you can assume that we've done our due diligence. We have a good idea that it's appropriate and suitable for your portfolio. If you're not a client, you got to make sure you do your own homework. Make sure it's right for your particular situation. These are also names that I own personally, as are all the names that we own in our, or that we've bought at the group level for the Wise Investor Group. I tend to own all of those myself. That represents a conflict of interest. So think about that. But Amazon, you all know Amazon. I think there are just a few things that stood out for me. One was we saw much better results from their Amazon Web Services, which over the last few years has been the driving force in their business. They saw their 17% growth year over year versus Wall Street expectations of about 14.9%. This is according to FactSet data. Raymond James, parent company here, they came out with a good analysis of the quarter. I think what Raymond James analysts noted was not only that beat, but also margins were ahead of expectations. Overall margins on the AWS side of just shy of 11% versus expectations of about 8%. And that was also the case across the company. Remember, Amazon became a bloated company during the COVID era. They had to add warehouses. They hired something like 100,000 employees. They had to keep up with incredible demand when we were all sitting at home ordering packages every day. In the last couple of years, they have really worked very hard to get back to bottom line execution, not just on the AWS side, but their overall business, particularly the retail business. So I think Amazon has the potential, and I know the Raymond James analyst agrees, to really be much more profitable going forward, much leaner and meaner, if you will. They also disclosed really good traction on their AI business. Raymond James has sort of a laggard to leader thesis. So if we were talking 12 months ago, Amazon was probably behind some of their peers, like Alphabet and Microsoft. Amazon has played rapid catch-up, and there was pretty encouraging there that their market share on the AI side has increased. Lastly, they came out with their estimates for capital spending going forward, higher than what the Wall Street was modeling for, but they're still able to do that in the context of better margins. So I think Wall Street has come away, and certainly the Raymond James analyst has come away with the idea that they can continue to spend aggressively on AI, which should theoretically translate into much better earnings and much better revenues over the next 5 years without really negatively impacting their cost structure. So the market responded to that pretty well. If you look at the risks to Amazon, I think part of the risks are what I just said, that they maybe have to spend a lot more than what they anticipated, and maybe that does hurt the margin profile at some point. So far it hasn't, but that's a risk going forward. Very competitive business, of course. Microsoft and Google are playing in the same sandbox as them. And then, of course, there's the risk of just consumer spending in general on their behemoth retail business. That's always a risk with Amazon, just like it is with Walmart or Target or any other big retailer. So there's certainly risk to the story, but if you look at their relative valuation, it's They're probably the cheapest relative to the S&P. They've been in several years, combined with better execution. I think Amazon is an interesting story here at these levels, particularly if you're looking at kind of the Magnificent Seven, which are the ones there that kind of stand out in a positive way. I think Amazon's one to take a look at. In a completely different sector, AbbVie is very interesting here, symbol ABBV, one of the largest and most diversified pharmaceuticals in the world. Again, this is a stock that we own in most of our client portfolios, and I also own personally. AbbVie is very interesting here because, if you recall, they used to be kind of a one-trick pony, if you will. Humira, their flagship anti-inflammatory drug used in arthritis and a lot of other things, was something like 70% of their sales at one point. This is 6, 7, 8 years ago. Humira has come off of patent protection. Okay, so what has happened the last couple years and even the last couple months is you've seen a number of what they call biosimilars come out that physicians can prescribe at a much lower price point. So Humira's market share has been declining pretty rapidly. But the point I would make is this is not a surprise to anyone. This has been telegraphed for almost 5 years. And AbbVie has been very transparent and accurate, for lack of a better word, about forecasting, I should say, exactly the rate of decline. In fact, they've actually been conservative. In fact, most quarters in the last year, they actually saw less of a decline than what they had telegraphed to analysts. But because there's this just overhang, AbbVie hasn't been able to get any traction recently. And I bring this up because if you look at their recent quarterly results, even with Humira kind of rolling off, not only did they beat estimates on the top line and the bottom line, they raised their guidance going forward on the bottom line and the top line. I read a report from J.P. Morgan, and the J.P. Morgan analyst was actually kind of openly surprised that the stock actually went down, I think 6 or 7% after the report, because he noted that AbbVie, quote, is one of the best positioned names in our large cap coverage. And what he was pointing to is the acceleration in growth in many of their other anti-inflammatory drug franchises, like Skyrizi, for example, that have largely offset the revenue decline from Humira. And remember, they've made major acquisitions. They acquired the parent company of Botox. They made over $10 billion worth of acquisitions in 1 week late last year, neither of which have really started to positively impact the bottom line yet. They will be accretive, but they haven't been accretive so far. So you have a really, really encouraging research and development pipeline story and revenue story for AbbVie once they get on the other side of this Humira issue. And my guess is, and this is just a guess, my guess is Humira will be much less of the conversation going forward in the next 12 months than it has been recently. But in the meantime, I think the risk is that it's an overhang on the shares. Okay, so if you're an AbbVie investor, you have to be patient. I don't think this is an immediate gratification story. The stock's not going to double next week. I think this is something that you need to hang in for a while. The dividend is close to 4%, so there's some compensation there while you wait, if you will. The valuation is not demanding at less than 14 times earnings. So there are definitely risks to the story. I think the risk would be that the company's own estimates are too aggressive, that the Humira decline is much more than they've telegraphed and they don't get as much support from the rest of the portfolio. That's the main risk. But I believe if you're patient, the story is interesting. So take a look at AbbVie, see if it might make sense for your portfolio. Just wanted to mention one more. I know my colleague Chase Hinderstein mentioned a few last week, and we'll have more for you next week. AT&T is, for the first time in a while, interesting. AT&T, as you probably recall, symbol T, by the way, AT&T has been kind of a mess for most of the last decade, and kind of a self-driven mess in the sense that management didn't really know in what direction they wanted to take the company. Remember, they made that terrible acquisition of DirecTV, right, and satellite dishes. They basically wrote that off at a multi-billion-dollar loss. Then they tried to become a media company, of course, right, acquiring Time Warner, and they tried to become a content play. That has been a disaster, pretty much. But then they've made some pretty significant management changes. And in the last year, what you've seen from AT&T is a much simpler story. They've gotten back to their core knitting of just telecommunications, and much cleaner story on the bottom line as well. So if you look at their most recent earnings report, the Raymond James analyst notes that, one, you've seen positive subscriber adds. That's a key metric for the stock. And they think, the Raymond James analyst believes that will continue, bolstered by significant cross-selling opportunities, penetration of broadband across the country, and improved network quality. So they think that that's going to continue. You've seen a pretty big ramp up in free cash flow. Remember, AT&T is a company that has a lot of debt, and they also pay a big dividend, over a 6% dividend. That requires cash flow to support both of those things. Well, cash flow has been ramping up. And the valuation, and they're trading right now at only, roughly 7.5 times earnings. That's close to the cheapest the stock has been ever, literally ever. So, again, not a sexy name, but if you're looking for an income producer, 6% plus dividend at a very reasonable valuation where their bottom line and top lines are inflecting positively, AT&T is something you may want to keep in mind. The risks, of course, are it's a very competitive landscape. You've got Verizon, you have T-Mobile. These companies once in a while like to have price wars that end up hurting everybody from a bottom line perspective. They're also, of course, subject and sensitive to consumer spending. If we go into a deep recession, people are, cutting their cable and they're not spending on additional services and products. So that's always a risk, kind of a macroeconomic risk. But all else kind of being equal, AT&T for the first time really in several years is screening as interesting. I'll leave it at that. As I mentioned, I own all of those in my own portfolio. Take that into consideration. But so those are some names that stood out for me. There are others in our portfolio that have reported. As I mentioned, Chase mentioned some of those. We'll try to get to more next week and the following week. We're about 2/3 of the way through reporting season, so we'll have other news to share with you. Until then, as always, I wish you good health and wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.